Welcome, Edgar, to the meeting. Welcome, Lovetta. We'll just give us 2 minutes before we start the session. Welcome, Philip Kabiru, to the webinar. You're most welcome. Welcome, Gilbert, to the session. Fode Bangura, you're welcome to the session. Patrick Banda, you're welcome. Thank you all for taking your time to participate in today's webinar. So welcome, Christine. Let's just have at least 1 more minute before we can start our session. Okay, it's now 5:03, we can start. Thank you so much for attending today's webinar. And you can always feel free to post your questions or answers in the chat box or in the question and answer box. I will be moderating this session. If you have any questions, just type them there and I will read out to the presenter who will address them at the end of the session. So my name is Joyce Shikuku. I am the East Africa Regional Coordinator for World's Mountain Initiative, and I'm based in Kilifi, Kenya. We are in week 7 of the Academy. Our sessions are focusing on measuring success and indicator development this week. And today our main topic of discussion is business development. And we are fortunate to have our presenter today. His name is Philip Oduma. He is a program coordinator working with USAID Nairobi. He has a Bachelor of Business Administration focused in procurement and supply chain management from Maseno University. He's currently pursuing a master's degree in project planning and management at the University of Nairobi. He has worked in a non-profit organization and has gained vast skills in research, orphans and vulnerable children programming, entrepreneurship and economic empowerment, training program management, information and technology, and team leadership. Welcome, Philip, to our session. And now I hand it over to you to take the lead. Thank you.
Okay, thank you, Joyce, and it's always a pleasure doing a session with you. And welcome to everyone to our today's session. And I hope that we're going to learn from each other. It's always the good thing with interacting as adults is always that no one normally serving the monopoly of ideas. It's always we are here to exchange ideas. So mine is just to lead, and then we're going to discuss and see how we can gain from each other. So today we are going to focus on how we can utilize monitoring and evaluation in ensuring that we start, operate, and maintain successful business enterprises. So that we don't just do them for the sake of opening in the morning and closing in the evening, but then it's something that are sustainable and long term. So I don't know whether we are all able to see my screen.
Yes, we can see your screen.
Okay, thank you. So so today's objective, we are going to first of all, we're going to learn about principles, objectives, and processes of enterprise monitoring and evaluation. And then secondly, we're going to provide a sufficient understanding of role of monitoring evaluation in rural development and be able to judge effectiveness of existing projects. So in this case, enterprises, M&D system, and business enterprises. So before I even start training or even telling you about what you're going to learn today, I just like us to think about enterprises that we know of, either we started or maybe a relative or friend started and failed. And then from there, we can be able to uh, just write it down and then we can discuss it based on what we would have learned and check whether maybe they did not do one or two that we're going to learn today so that they could be able to sustain their enterprises. So maybe I could start my story. Um, I remember 5 years ago, I was really geared towards starting a business. So very good at talking, and I went to a certain hotel and I observed they were not having key holders that were worth the kind of hotel they were. And I was able to pitch the idea to the business manager of that hotel, and then I was able to tell them to give me business of supplying them to key holder. First, I'd never done a business before. Secondly, I'd never experienced any business within the hotel. But then what I can tell you in short, I lost my money. I was never able to supply the key holders. And I lost even my friend who was the hotel manager because they really trusted me to supply them with the key holders. So that was the first time I ever tried business. But then I failed and I lost friendship. So I was able to learn from that. So when I'm talking to you about business, I'm going to talk to you about from the perspective of failure. And I think in case I was to start another business, I would start it differently. So, what is a Mandi? So I know somebody would be asking themselves, like, what is a Mandi? So, a Mandi, as you can see, is a process of continual gathering of information and assessment of it in order to determine whether progress is being made towards specified goals and objectives, and to highlight whether there is any unintended positive or negative effects from a project and its activities. So, in business context, before you start or whenever you're doing a business, you need to be gathering information. So how do you gather information? The other day, I was talking to one of our beneficiaries. I work in informal settlements in Nairobi. So we have one of our beneficiary who's been doing a business, selling second-hand clothes. And she told me that she's done this for 13 years and she's been known in the streets as the best. In Kenya, we call it mitumba, but then second-hand clothes. She's the best. And then I asked her, do you have anything that could really show me that you're the best in this business? But then the lady told me, like, I'm the best. I've sold for 13 years. But then I was like, now, are you able to prove that you're the best in the business? Then I was able to assign her that, okay, so going forward, this is what I'd like us to do. I'd like us to develop records because you can only know you're the best, either you're doing well or you're doing poorly. And for it to be the best, it means that you're doing well. So that means that every single day your growth, I mean your turnover or number of sales you're making in a day is improving. And that means that also the expenses are maybe probably going down. So it means that your markup or the profit is really increasing. That's when you're doing well. So the only way you can be able to do that is when you have business records. So that is what is known as monitoring. So the only way you can monitor your business is when you have records. So in M&D, we call them source documents. So I had to sit down with this lady and we had to develop what is known as source document. So this source document for business is records. So we have one of the records that we have is sales record. We have stock or inventory because when you purchase, you have to do that. And then we have another one for expenses. So when we did this with her for like around 3 weeks, and we were able to check on the sales, check on stock, the way the stocks are moving and the expenses. Then we realized that the business is not doing well. Actually, the business was dead. It's like, I don't know whether you've ever heard of a patient that is dead in hospital. The only thing that is keeping them alive is just the oxygen. So once you do away with the oxygen, the patient is technically, I think it's called vegetative state. where you're only depending on oxygen. Once it's gone, you're gone. So the business was technically dead. So the only thing that happens for this business is that the lady could take loan from maybe a saving and loaning group. She could get loan from MFI. So whenever she gets money, she pumps it in the business. So what keeps the business running is the loans, but not based on sales and expenses. So we're able to see this. So that means that we're able to track. So tracking is monitoring. So once you monitor, then you'll be able to know whether your business is doing well or poorly. That is the place where we're talking about positive or negative effects in the business. So I don't know whether from the explanation we're able to understand what is monitoring in terms of business. So you can never say you're monitoring a business without uh, records. So you must, as a business person, you must have various records. So depending on what you're doing, the basic records that you must always have is sales, stock, and expenses record. And expenses also include your salary. Because when you talk to somebody that is just starting up and you ask them like, okay, how much do you earn from your business? And like, hey, this business is small. It cannot pay me salary. But then I'm like, you wake up every morning and work the entire day. Where do you get the money that probably you pay rent or even pay bills with? She's like, I get it from the business. Then it means that the business is paying you. So what happens is, if you don't track the kind of expenses you're incurring in the business, it means you're stealing from the business, and the business will never do well. So that is one of the expenses. I mean, the record that you need to be tracking or monitoring to see whether you're making positive or negative effect in the business. So, why do we need to track uh, why do we need to monitor activities or track activities in the business? First is for accountability. So the way I've explained, technically when you're starting a business, you like, unlike, like let's say I'm starting an NGO, I depend on donor maybe for grants or such kind of stuff. But then when you're running a business, you're the sole donor to that business. So you need to be first of all accountable. So whenever you, like let's say you pump in 1,000 shillings to that business, at the end of the day you need to ask yourself, how much have I been able to make from this 1,000 shillings? And you need to break it down. I used maybe 200 shillings for transport to go make purchases. I used maybe 100 shillings to pay bills such as electricity and also licenses. So it brings about accountability. So when you're talking about accountability, you're able to show from the records that this is what I was able to do with the money I generated from the business. Because most of the time you realize, especially for small businesses, we are not accountable. So you probably made maybe 10,000 shillings in the evening, and then 2,000 shillings you branch with it to maybe a local bar in the evening. In Kenya, we say you say sorry for your body, kupigia mwili pole, and then maybe 1,000 shillings you go maybe do some nyama choma or roasted beef, something like that. So at the end of the day, you're not able to track your expenses, and then you not be able to account for every single shillings or or franc, because I've seen some people from Rwanda here. Every you need to track every single coin, and the moment you're able to track, that means you're becoming accountable. And then for operational management, there's no way you can manage when you don't have idea of what's happening. But then you can never have idea of what's happening when you don't have records. So once you're monitoring, like let's say, what time do the staff get to work? That means that you're having, like let's say, where the staff sign in when they're getting to the business, and then when they get out, so that you're able to control the time the staff get to the business and leave. And then you should also, they help you to make business idea, I mean, decisions. So like let's say with sales record, that's when now you decide like, oh, there's this product that is not really doing well in terms of sales. Or okay, like let's say you've noticed like through the sales record, you can notice that this product that normally during the week it doesn't sell, it only sells during the weekend. So it means that for operational management, you will decide not to buy a lot of that particular stock during the week, but then buy a lot of it during the weekend when it's selling more. So through monitoring of your sales, you should be able to make such kind of decisions. And I think that also answers the strategic management. And then for capacity building. So how will you know that your staff require this kind of capacity building, or even yourself, when you don't have records? Um, Maybe there's this stock that normally goes bad, and the reason why it's going bad is not because it's not selling, but because maybe the staff, they don't know how to handle it. So from the stock, you can be seeing that this stock is not doing well. I mean, the stock or inventory record should be able to see that this stock is not doing well. And then decide that I think it is maybe due to lack of capacity from my staff. So you train them on how to do it. And then from there, the stock will now stop going bad because the staff will now know how to handle it. Um, so here we just definition of monitoring, evaluation, and learning. So I think we've talked about monitoring. So monitoring is basically tracking. And then evaluation is what we do. Like, let's say, how do you, when you want to know that uh, 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 maybe your customers are impressed or they're getting value for their money, how do you get to do that? So occasionally you'll come up with questionnaires that you give to your customers so that they can be able to give you feedback. That means that you're evaluating. It's like a teacher giving students a cut so that they can be able to evaluate whether these students are really getting whatever they are training. So even you as a business, once in a while, you need to be evaluating, like let's say maybe customer satisfaction. How do you know customers are satisfied by your service provision? So you do like say what big businesses do, make a questionnaire, and then collect data on customer feedback. And through there, you'll know that, okay, this customer, normally you've been opening at 8 and then closing at 5, but then your customers prefer for you to maybe extend even up to 8 p.m. because that's when they come back to the estate. And through that, you'll be able to know that most of my customers prefer longer business working hours. So that is what is known as evaluation. And learning. Learning is now, like let's say, through your monitoring and evaluation data, like let's say from sales data or even expenses data, you should be able to learn something. So you can be able to learn through your the data that you have that there's this product that we are selling, but then this product is not selling well, and there's no need of us continuing selling. So that means you're learning from the monitoring and evaluation data that you've been able to collect. Learning also is when you also decide that uh, based on the evaluation that we conducted, our customers suggested that we should not be closing at 5, but instead be closing at 8 p.m. So that means that you learned from the evaluation process that our customers mostly prefer buying from us from 5 to 8 p.m. So it means that we should be open for longer hours. So that is now the difference between monitoring, evaluation, and learning. And I hope that we've been able to understand that. So don't worry, we'll have if you have any question or comment, you can always post it at the Q&A down there, and then we'll be able to handle it at the end of this session. So I think I've been able to take you through evaluation bit of it. So I hope that we've been able to understand. So evaluation is periodic assessment of the design, implementation, outcomes, and impact. So like let's say design is you decide that you'll be opening from 8 to 5. Uh, so that means that if your customers are not okay with opening between 8 to 5, then you can always be able to change. So that means you give them feedback forms, you have suggestion boxes, or you have maybe a form that they can normally be filling once they're leaving. And then implementation is how you're implementing, like let's say sales and such kind of stuff. And then the outcome and impact of your interventions. So in this case, of your enterprise. Yes. So evaluation criteria. So when you're conducting evaluation, the first thing you check on is relevance. So what is relevance? So relevance is whatever, like let's say in your business, are you meeting the community needs? You know, you could be selling, like let's say product, but then there's this example that I normally give when I'm working with entrepreneurs, especially when I was in the lakeside of Kisumu. I could normally tell my participant and tell them, like, if you look at this business, let's give it 3 months, and then after 3 months, it will be closing. And it's not that I'm a psychic or I'm a wizard or something like that. It's just like based on my experience. Most of the time you get like, let's say, ladies, Joyce, which business do ladies prefer mostly to do?
Maybe selling cosmetics and
Another one?
hair beauty products,
Thank you.
salon.
So, yes, now there's always one that is known as cosmetic. Uh, any lady, if right now, if you were to ask them, like even right now, if I was to go out there and ask a caregiver that if I give you 15,000 right now, what business will you start? And that I'll go to Uganda, get some trousers and shirts and I don't know chiffon or I don't know how you call them, and then that's the kind of business they will be able to start. So you see, how did you know that people need that? And then there's one of them that I asked, like, now, which business would you like to start? Like, you see, I've normally seen so many people walking along this route, and I'd like to start a chips and sausage business along that route. And then the question I asked her, like, and then she was to also start like a small hotel just for, like, let's say snack, that is chapatis and beans. With her, she was presuming that now that there's always traffic of people walking there, those people would like most likely eat chapati and beans. And my question was, how sure are you that those people are hungry? Yeah, the fact that people work there does not mean that these people need food. So probably there are people that they eat at home and then they're just going to town to do their transaction. So they'll not be able to buy from you. And then you get people selling, like, let's say, trousers and these beauty products, who said that whenever you see ladies walking along that street, they're interested in buying your product. So that's now where you do evaluation to check whether whatever you're offering is having any relevance to the people that you're targeting. So you need to do an evaluation to check whether you're offering, you're addressing the community need or your customers need, so that you don't sell. Because most of the time I say that, okay, you get like a lady, she really loves chips, so she'd like to start a business because she loves chips. But then your customers are not you. So you don't sell, you're not going to sell to yourself. Because you realize, like, maybe in Kisumu, the cost of operating like a chips business, that is the oil and the potatoes, is quite costly. But then there you are, you're selling chips, no one is buying. So at the end of the day, you go back with it home and then the business will fail. So you have to check on relevance. So business must be able to address community need, not your needs. So if you love chips, you can start a business, but then from your salary that you'll be paying yourself, you can go buy chips. And then efficiency. So is your business able to offer services, addressing the customer's need at the lowest cost possible? Do you have to, like, say, travel to Uganda, maybe spend 5,000 Kenyan shillings? That is like uh, 50 USD? I think so. Yeah, 50 USD. That is 50 USD. So you spend like 50 USD, you're going to purchase maybe clothes worth 100 USD. So that means you're spending 50% on transport alone. You've not even paid licenses and rents and bills and other bills. You're spending like 50% 50% on transport alone to procure your product. So you must be able to sell, but then in an efficient manner. So you should be able to decide on a business that you're able to spend as lowest as possible to achieve as much as possible in terms of profitability and then effectiveness. This one is where you ask yourself, did the business change existing practices in a beneficial manner? How effective is the business that you're doing? And then the impact. What impact is your business having on those that are depending on it? Are you able to like have referrals? Because most of the time businesses they don't really market for new customers. As a business person, you're supposed to be marketing for repeat and referrals. That is how you grow as a business. So if you don't have an impact on, like, let's say Philip today, that means I will never buy from you. So that means that you'll be investing in getting new customers each and every single day. So as a business person, you should be able to ensure that whatever you're selling, the product, and even yourself as the person selling, you have an impact on the customer. So the customer is now an ambassador. Like if you want to buy like new maybe chiffon, uh, Philip is always the person to go to. So that means that you'll be having referrals and you'll be having repeat customers. And that means your customer acquisition cost will go down and that money will now be going to profit. And then sustainability. Is it a business that you're able to sustain? Like most of the time you get a business that if you don't put capital on it today, it's going to die the following day. And it means that that's a business that you should not be operating in the first place. So you should be able to operate a business that can be able to sustain itself without requiring, like, let's say, loans or additional capital. So those are the things that you should be able to check on when you're evaluating your business. And the evaluation, as we had agreed, is not done on a daily basis. Evaluation you can do, like let's say you start your business today, after 6 months, you can even decide on maybe two. You're checking on relevance and maybe sustainability. You check on whether is this business relevant to the people I'm offering services to, or is it a business that I can be able to run even after 2 years? That means that you're checking on sustainability. So you don't have to check on the five criteria. So you can always decide on one or even two or even three, and then it's done within a specific period. So you cannot be doing evaluation every single day. Yes. Now, why uh, do we have to do monitoring evaluation in a business enterprise? So first, it gives clear and concise information on what is happening. So the way I mentioned, through monitoring and evaluation, you will be able to get exact information or concise and clear information what is really happening in your business. So through monitoring, you'll be able to know um, how much sales are we making, and is it really profitable when we're making such sales in a day, or even in a month, or even in a week. So through monitoring and evaluation, you should be able to know whether you're making impact, or you're even uh, okay. So what I meant to say is that through monitoring evaluation, you'll be able to know uh, clearly the direction your business is taking, and through monitoring evaluation, and now that you now know the direction you're taking, you should be able now to make decision on whether to continue doing a certain aspect of the business or stop or something like that. So that means that you'll be able to give to get clear and concise information on what's happening on your business. And then you'll be able to check on input monitoring. So input, normally in a business, we have several input. So input could be in terms of capital. So you'll be able to monitor, like, okay, I pumped in or I injected maybe 10,000 shillings in this business last month. What have I been able to achieve with that? And the only way you can be able to know what you've been able to achieve with the input is, for instance, using the sales record. So you'll be able to see, like, before I pumped in the 10,000 shillings, I was making sales of maybe 10,000 a day, but immediately I was able to input or inject the 10,000 shillings. Now I'm doing 15,000. So it means that through that, you can be able to see the impact of the input that you're able to put in that business, uh, and whether the impact is positive or negative. And if it is negative, then you will see how to develop a stopgap measure. And then risk and reward evaluation. So through monitoring, you'll be able to spot risks earlier, because like let's say you've introduced a new stock that you've never been able to sell. So when you start monitoring, then you'll be able to see that, hey, this stock, since I started selling it, instead of doing well, it's been going down. Like the first day I was able to sell, like let's say 20,000. The second day I did like maybe 15, and right now I'm doing 5,000. So it means that the risk is not worth taking. So you stop it from there. Or from there you can be able to learn why it is not doing well. And you put in a stopgap measure, and now from there you can be able to work. So through monitoring, you'll be able to see to monitor the risks, and be able to make decisions early enough before they affect business. And then assessing new possibilities. So when you're doing business and you're monitoring, you'll be able to know, like, we've been doing well for the past 3 months in this area. So could it be possible maybe we start another branch somewhere? Because most of the time people, one of the biggest reason as to why businesses fail is normally overscaling. Most of the small business, we just feel like, now I'm doing well, I need to start somewhere, or I need to now maybe increase the number of purchases I'm making. But you see, without you making that decision without data. So when you have data, you can be able to decide whether making a new, like let's say opening a new branch, if it is possible, increasing the amount of stock you're purchasing, because that is another maybe form of risk should be taken. But then when you have data, making decision is really possible. So that's the reason why we need to check on, I mean, really focus on monitoring the growth and everything that we do in business. And then the other one is overall progress report. So progress reports will come in terms of, like, let's say you're doing uh, maybe balance sheet where you're able to compare your assets and liabilities. So the only way you're able to do that is through combining various records. Like let's say you're combining sales, you're combining stock, you're combining expenses, and even the cash flow, so that you're able to now generate an overall progress report and see where you are in terms of liquidity, in terms of liabilities, and also assets. Um, Innovation and diversity of opinions and thoughts. So monitoring will help you with innovation, because like let's say the way I'd mentioned, through monitoring you'll be seeing that there's a certain stock that is not doing well. And then through that, you'll be able to know that, hey, why is it a particular stock not doing well? And then you'll be able to track and know where it started not doing well. And from there, you'll be able to come up with new ideas on how you can be able to boost sales for that particular stock. And it will help you now be innovative so that you can be able to boost its sales. Then common terms that we normally use in monitoring and evaluation. So input. So input basically is resources required to achieve outputs. So like in a business setup, you have the sales. I mean, you have, like, let's say capital, you have the stock, anything that is able to help you achieve your goals. That's what is known as inputs. Those are the resources. So it can be the like let's say the assets, if you require like maybe machines to operate your business. And then the output is the tangible result of the input. So like let's say you got a machine. So the output is what will have been produced by the machine. And then the outcome is what comes from the output. So like let's say you've bought a machine that has been able to give a certain product, and then now when you sell that product, now that's the outcome. So how much have you been able to generate from that output. So the output is, like let's say, you're making peanut butter. So that's the output. Now the outcome is how much have you been able to make from the peanut butter that you've been able to sell. And then the objectives. So I know this is not so much within business setup, but then objective is what what contributes to the overall project goal and allows measurement of the success of the program. And then after objective, then we have the goal, then impact, and the one that we need to focus on is indicators. So indicators, and this is very also very key to business. So indicators, what is an indicator? So an indicator is a measure of achievements of the outputs, outcomes, objectives. So first, they have to be measurable, and then they have to be accurate, and then verifiable. That means that you can be able to verify, and then they have to be very specific, not vague, specific. So if you want to say like, if you want to say that your sales, you've grown in terms of sales, you have to be very specific, like how much. And then time bound. Time bound must be within specific period of time. And then it has to be simple, something that anyone can be able to understand. And then something that you can be able to achieve. Like let's say you've been making sales of 10,000 shillings a month, and then maybe you want to see whether your business can be able to grow within a year, and then you set a target, like let's say 100,000 in 2 months. That is not obtainable, and you'll not be able to achieve it. So it has to be something obtainable or realistic, something that very realistic. So we're going to talk about indicators that you need to focus on as a business person. So principles of monitoring and evaluation. So what are these principles? So first, it should meet the needs of all stakeholders. So when you're doing evaluation, don't just focus on you as a salesperson. Focus even on the customer, not just what your business is benefiting from. Also focus on what the customers are benefiting from your business. And then it needs to measure the impact of enterprise strategy on the livelihood of those involved. So that's what we are talking about, the need. So when you're measuring your business growth, measure whether you're meeting the needs of your customers. And then identify what needs to be done, how, where, when, and by whom. So technically, this is by developing a system. Because once you have a system, then you should be able to define. I know a system must be able to define clearly who needs to do what, when, where, and uh, and then you need to identify what works and what doesn't work. And then it needs to be sustainable, so you don't have to spend so much on the monitoring and evaluation process, and participatory, so you don't have to force your customers, like let's say with the questionnaires and the surveys, and it need to be very simple, be useful, and something that can be used. So we have here the indicators that I was talking about, indicators that show that your business is towards achieving its goals and objectives, and a business that can be sustainable. So, number one indicator is number of satisfied customers and meeting the expectation and needs. So how do we know that we have a good number of customers, that we are satisfying their needs and expectation? So number one is through customer feedback forms. So as a business person, you need to develop like a sort of a business feedback form. So it could be in soft copy, where you just share with them the link, and then they be able to just key in. And the way we've said, it needs to be very simple. It's supposed to be very short, simple, and precise. Don't do like 10-pager feedback form. A customer will tell you like, okay, let me go with it home. I will come back with it. And then you'll never even see the customer again, because they'll always be embarrassed when you ask them like, hey, did you fill the form? So it needs supposed to be something very short and on point. So it's one page, and through that, you'll be able to get feedback from customers. and they will be able to know whether they are satisfied and you're meeting the expectations. And I think questionnaires and the forms should be the same thing. And then also number of repeat customers. You know, you cannot say that you're meeting customers' expectation and you're satisfying their needs when you never see a customer twice. Because if I'm satisfied, means I'll come back tomorrow. And probably when I come back tomorrow, I'll be coming a friend or a relative to buy from you because you're meeting my expectation and serving my needs. So that is something that you need to take care of. And also how you know you're meeting customers' expectation is when your sales are growing. Because you know you cannot tell me that you're meeting customers' expectation and every single day when you run your data your sales record is normally going down. So from the sales record, when your sales are growing, it means that you're having more customers, and probably we can somehow say that that is through the customer satisfaction and also through customer database. So as a business person, you need to have a database of customers. And when you see the customers database growing, then it means that you growing, the number is growing and you're satisfying them. Then, which is very key, net profit. So here you need to track your net profit over time. So is your company getting more or less profitable year to year, or maybe a period to period? So this one, how do you calculate net profit? Net profit is simply sales, I mean sales minus expenses. So the way people calculate profit, and just you can concur with me, you hear people saying that, you know, I bought this shirt at 500 shillings and I sold it at 600. So I've made a profit of 100 shillings. True or false?
Very true. That's how most people calculate their profits.
Yes, but you know, that is not profit.
Mm.
Yeah, you know, profit should be after you've minus. So you bought it at 600, you bought it at 500 shillings. And then you sold it at 600 shillings. But then, you know, you incurred transport probably to the market. And then probably you paid the license that normally is paid, like say 20 bob a day. And then you ate lunch. Because, you know, since you don't pay transport, you get your lunch from the business. That was an expense. So net profit is calculated when you've deducted all the expenses incurred from the sales that you made. Then you realize whether you're making profit or not. So that is how you know whether your business is doing well. So that means you need to really keep a record of all the expenses that you're incurring to make a single sale. And then what is known as quick ratio. So quick ratio is just how liquid your business is. So are you able right now, are you able to pay your debts? You know, if your business is not able to pay, like, let's say as an individual, you're earning salary, and then you owe someone a debt, and then the debtor comes like, hey, I need my money paid right now. Are you able to pay it? So that means either you're liquid or you're not liquid. So that is a ratio that you need to check on. So quick ratio, it helps you to track whether your cash, securities, and the money you expect. That means that even like let's say that debt that you're owed is enough to cover your liabilities. So if you've added all the money you have, I mean the cash, securities, and the debts that you owed, and you're still not able to pay your liabilities, that means you're running at a loss. So you need to, like, let's say, readjust your strategies. So how do we, what source document do we use for that? So this one is the cash flow statement. So you're able to check on your cash flow and sales record and also the debtors, because this one we're also talking about debts. So those debtors that owe you money, so you should be able to add all those and be able to see whether you're able to pay your liabilities. If you're not able to pay your liabilities, then that's a business you need to think twice. And then net income ratio. So what's the difference between income and profit? So income is what we normally talk about. You bought it at 500 and then you sold it at 600 shillings. That means that what is the income? Income is 100 shillings. That's not profit. That is just income from sales. So net income ratio. So net income ratio is the amount of money left over after operating expenses are subtracted from the revenue. So that is just income, not profit. So an increase in net income means that either revenue is growing up, costs are going down, or some combination of the two. So net income means that so like let's say last month you sold total you had a net income of 600 shillings, and then this month you have 700 shillings. It does not mean that maybe the expenses, I mean that you made profit. The only thing is that maybe you've not paid electricity because maybe there was a blackout. So you cannot like really say that your business is profitable because you did not pay electricity, because next month you'll be paying for it, right? So it just means that probably the expenses went down, and expenses can always go down and come up again, but you need to also track on your net income. And then activity. So activity is basically, are you managing the assets of the company effectively? So this is technically the contribution of, like, let's say you bought a machine to help you in operating your business. I hope I'm still within 10, yes, 3 minutes. Um, Whether the machines you bought for the business are helping you generate income as much as possible. So that means you need to really do a lot of tracking of inventory records. So you're able to know like how much we produce this today, how much we produce tomorrow, how much we will produce the day after tomorrow. And through that, you'll be able to see activity within the assets that you're able to purchase. And then break even. So the break-even point is the number of units that needs to be sold during a given period in order for the company to cover all the production costs, sales costs, and business overhead cost. So this is where most businesses go wrong. So break-even is where, like, let's say you start a business today, you'll be starting, like, let's say you'll be investing like maybe say 100,000 shillings in it, right? So break even is when you'll be able to get back the money you're able to invest in that business. And it doesn't come like immediately. Normally it is uh, predicted that as a business person, you'll only break even after 6 months. But then you realize, like with most of us, when you start a business, you want to like buy a car immediately because now you feel like most people in business buy cars. So that should not be the case. So break even period is the period where you're now been able to cover all the costs that you incurred to start this business. So that means that you're able to get back the amount that you plowed in the business. So the other one is social media engagement. Right now, most of us, we sell through social media. So you need to really track also on how you're engaging with the business. I mean, with your customers through social media. And the good thing with the social media platforms, when you're running a social media, I'm not a social media expert, but I know if you want to do well, start a page for that business. And when you start a page, there are always normally where you can be able to check on how you functioning as a page, and you'll be able to see how many people you're able to meet, how many people clicked even on the post that you're able to share, how many people shared the post that you shared, how many people liked, how many, like, you're able to see the engagement that you're having within posts that you're creating. So there's no point of creating a post and you only get like a one person, it's the only one person who always respond, only one person share. So you need to check on your social media engagement with customers. So that is very key, because if your business depend on it, then you need to really check on it. And then employee retention rate. This is very key. Most people never understand that every time you lose an employee, it means you're always taking a step backwards. So you really need to really take care of that. So you need to work with the employees and ensure that you're able to retain them as much as possible. So that one depends with how you relate with people and how you maybe capacity building them and how you're able to enumerate them in a way that you're able to beat competition. And then sales indicators, you need to really track, because it is most businesses depend on the number of sales you're making. So you really need to track on that. So that one, there's no any other rocket that you use the sales record. So this is the record that I always advise small business people to check on like on daily basis, so that you're able to see how much they make today, and then set a target for tomorrow. Then your business will always do well. And I think that's the end of my presentation. So thanks all for listening to me. So I don't know if you have any question, Joyce.
Thank you so much, Philip, for the wonderful presentation. We've really learned a lot. So we have a
Mm,
question here from Fode Bingura. Fode is from Sierra Leone.
mm.
He says, thank you so much, Philip Oduma, for your explicit presentation. From the contrast of carrying out research and pre-surveys in starting a venture, what are the basic tools normally required in carrying out an effective monitoring and evaluation?
Oh,
You
okay.
can take that.
So, thank you for that. So, as we said, okay, for evaluation, bit of it we've agreed. Evaluation is done within a period of time. So, evaluation, you can evaluate the records. So you don't have, like, let's say, most of the time we think that evaluation we must conduct surveys and the questionnaires. So I think the basic thing that we normally do as business. So within a period of time, we give customer feedback forms. So that is one way, and the feedback form is technically a questionnaire or a survey. And then for monitoring, there's no any other way that you monitor in a business. Business, you monitor through records. So the way we've said that the first key record in a business is the sales record. So you're able to, I wish maybe I could also come up and share with you maybe a basic sales record. So sales record is just maybe the item sold, the quantity, the like say the price and the amount. So you're able to know like, okay, today this blue shirt you're able to sell 10 of them, and this is the amount you're able to sell. So it helps you to track what was sold at how much and the total amount of sales done in a day. So you don't even need to have a form. You just a basic phone. Just develop an Excel worksheet using your phone. Then you can be able to enter. And the good thing with that, you can be able to analyze using Excel very easily. The other way to monitor business growth is through stock. So stock record will be able to help you know which stock is really sellable and sellable at what time and when. So like there are those stock that you're having in your business that only goes maybe during the weekend when children are at home. I mean they are home, like let's say sweets and blah blah blah. You'll always be able to track and know, like when I'm purchasing this kind of stock and this one, I'll buy them during the week. This one, I'll buy more of it during the weekend. So that one you can be able to only know when you're tracking your sales. So that means, not step, stock record. And then also stock record will be able to help you know which one is almost going bad, which one need to be sold. In procurement, you learn last in, first out, or first in, last out. So it depends with what the kind of products you're selling. The other key record that you need to work with and monitor is the expenses record. So that is very key. You need to monitor that because as I was telling you that most businesses fail because they confuse revenues with profit because they don't normally sit down and just calculate. Before me selling this one chart, this is the amount of money it costed me. So you need to have a very explicit expense record that you're able to state all the expense. If you use transport, you indicate there. If you buy, like let's say, a license for that day, you indicate it there. If you paid rent or stall space, you indicate it there. So at the end of the day, you'll be able to know how much you've been able to do. And then we also have what is known as the cash flow. Cash flow is the money getting out, that getting in. It doesn't matter whether it is from sales, it doesn't matter whether it is from maybe loan. All the money that you put in your business that day, you have to record it. And then all the money that is getting out that day, you also have to record. That is the cash flow record. So you need to really record that. So I think to me, those are the basic records that you need to have to monitor your business and evaluate them effectively. Thank you. I don't know whether I was able to answer you.
Okay, thank you, Philip. So I also
Mm,
have a question for you. Let's say I've started a business. It's barely a month old, or yeah, it's just very new.
mm,
Uh, I'm the one operating this business. Am I supposed to pay myself? Because considering if I had put someone to operate the business, I'll pay them. But now, since I'm a sole proprietor, am I also supposed to add my salary or wage in that business as well? Or do I count the energy that I've put in the business morning and evening as part of an investment in the business?
Joy, at the end of the day, you have to pay bills, right?
Mm.
Yes. So, and then, since you have to pay bills, where will you get the money from to pay the bills?
From the
And just be
business.
honest with me, from the business. So, if you don't set that this is what I'm going to pay myself, that means you'll be stealing from the business because you'll go beyond what you're supposed to be paying yourself. So, the moment you start a business, know how much. Like if I was to employ somebody to take care of this activities that I'm doing, how much would I pay that person? Then you declare that that is what you're supposed to be earning. And I've worked with entrepreneurs, and they've done that effectively, like especially the border people. So this is what we do. We agree that any single money you make during the week, you take it to the bank account. And then you say that how much was I supposed to pay myself? Like let's say 200 shillings a day. So in a week, that is 1,400, right? So you
Mm.
go to the bank account, withdraw the 1,400, and probably since they've hired that motorbike, the one of the motorbike would also require their 350. Then you withdraw that one also, the 350 times maybe 6 days, then take it to the one of the motorbike, pay yourself 1,400. So it means anything that is remaining is saved for your business. So that is what is known as now the revenue that you've gotten from there, that you've raised for the business. So if you don't declare the amount that you pay yourself, so it means that you'll be going above God, and it means that you'll be eating so much from the business. And that's why most of the startups, they don't go anywhere far, because you start a business today and you depend on it. You pay school fees with it, you pay rent, you pay all your bills with it, and it's not able to sustain the expenses. And then the next thing it is, you'll be failing, and it will be closed.
Okay, I'm seeing 4 days comment here says, thank you, Philip. I think his question was answered. So another question I have for you, Philip, is what about the
Mm.
returns inwards and returns outwards? How do you calculate that?
Return, okay,
Return
maybe,
inwards and return outwards. For instance,
okay.
let's say I'm
I'm not
dealing with,
getting the return bit of it, yeah?
okay, let's say for instance, I'm selling bread, or
Mm,
I get bread from the supplier, but by the time I sell it out, it
mm.
has already expired. So I cannot sell it.
Oh, oh,
Yes.
okay, I get you.
How do
Mm.
you calculate returns inwards and outwards from the profit and loss account?
Wow, so definitely, so you see, once you had sold something, see, it was already in your sales record, right? Sold, and then now it is
Mm,
returned back. So to me, that will definitely go to your expense record, because that's an amount that you had incurred. Because the okay, in business we have the debit and credit bit of it.
mm,
So now that the thing is back, and you have to give another. So whatever you're giving is now going to on your cost, because it's not money that is coming in, it's money that is
mm,
going out, but then it's going to nowhere. So it means that it's going to fall in your expenses, not sales. So it
mm.
means that whenever you're calculating it, it's the money that has gone out, so it is an expense.
Okay.
Yeah.
So I also have another question on,
And also, yes, and also, that one will also have to will also have an effect on the stock record, because it had already gone out, so you need to return it in also.
mm,
So it doesn't, yeah, so it has to, so when you're returning it in, so it will affect two records. It's going to affect sales and expense. It's also going to affect the stock record.
okay. So
Yeah.
I see a lot of people now doing QuickBooks. They use
Mm.
QuickBooks for calculation. What is the advantage or disadvantage of using QuickBooks in business?
Um, Okay, so I don't know for a small business setup, I won't really, QuickBooks is technically Excel, right? But now Excel that imeomoka in Kiswahili. So for a business that is just starting up, I think you don't have to, because QuickBook will require expenses, and probably if you don't know how to operate it, it will just be an expense that you doesn't really need when you're starting. So I believe that if you really need, like, let's say, to set up a system, we have web-based systems that you can really use that can be able to help you do, because QuickBook is really meant for serious businesses, and probably it will come with a cost, because maybe you'll need an accountant to operate it. But then when you're starting up, you don't need those additional costs, like, let's say, employing someone to operate a QuickBook for you. So what I would
Mm.
suggest, in through internet, we have so many sites that you can be able to use to operate your small business, that will be able to help you do the function that a QuickBook system would be able to do. Because QuickBook is just, like, let's say, using Dynamics and Navision. So so you don't have to use those systems when you're starting up. That's what I would advise someone.
Okay, thank you so much,
Mm.
Philip, for the wonderful session. And thank you so
Mm.
much for answering our questions. I trust and believe people's questions have been answered satisfactorily, and we've learned a lot throughout this session. I want to thank everyone for taking their time to participate in today's webinar and attending. We do not take that for granted. Just a reminder, we're going to have another session on Thursday on monitoring and evaluation and CBO NGO development. And I hope that you're going to have, to educate more people on the same on Thursday. That is
Okay.
it from our end. Thank you so much, Philip, for taking your time to participate in this webinar. We appreciate your presentation and your participation as well. And
Okay. Thank
that
you,
marks
Joyce,
the
and
end of our
thanks to everyone.
presentation.
Okay. Thank you, and have a lovely evening.
Thank you so much.
Okay.